Also in the news, disappointing economic data out today from Singapore. Non-oil domestic exports grew at a slower pace for the fifth straight month in April, rising 6.4% from a year ago, following a 7.7% increase in March. Compare that to the double-digit growth in December and January. Now, analysts polled by Bloomberg expected export growth of 9.2% last month. Meanwhile, in the markets, investors are worried about global economic growth decelerating, with major Wall Street banks warning of a possible recession in the US in the next 12 to 24 months. It comes as the Federal Reserve aims to tame inflation by raising interest rates without causing a recession. But to complicate matters, there's the ongoing Russia-Ukraine war and China's COVID-19 lockdowns adding to the uncertain outlook. Joining us is Associate Editor Vikram Khanna. Vikram, when we see what's happening on Wall Street and around the world, stock markets sliding and inflation rising, are investors right to worry that a recession may be around the corner?
Well, there's nothing certain about economics, but I would say that the risks of recession are certainly rising. Well, what's basically happening is that all three of the world's largest economies are slowing down at the same time: the US, the European Union, and China. And the US Federal Reserve is tightening monetary policy into a weakening environment. So if you look at the US, for example, the first quarter growth annualized came in at minus 1.4%. The housing market is under stress because of higher interest rates and higher mortgage rates. There's a negative wealth effect because of the slowdown or the correction in the stock market, which will affect consumption, which is the main driver of the economy. And all the forward-looking indicators are all trending down. In the European Union, the European Commission has just downgraded its forecast for the European Union to 2.7% this year from 4% in February. That's as recent as that. And even that 2.7% is uncertain because the course of the war in Ukraine, etc., are still uncertain. And then in China, you've had a very bad month of April. You've had a contraction of the economy, basically. Retail sales down 11%, industrial production down, and the lockdowns, we don't know when they're going to fully end or whether there'll be new lockdowns. So there's a lot of uncertainty there. So you have all three major economies basically slowing down. And then in Asia itself, around us, we have several countries that have raised their interest rates in the last couple of months: Australia, New Zealand, India, South Korea, Malaysia. Indonesia could do so, and Philippines as well, over the next month or so. So you have higher interest rates in the region, which means slower growth. And even Singapore has tightened monetary policy 3 times since last October. So you put it all together, and you do have a rising risk of recession.
So, Vikram, based on what you've just said, major economies, we are seeing them slowing down. And if they continue to slow down in the months ahead, what will the outlook be for Singapore? What does it mean for Singapore, and what can we do about it?
Well, one of the good things that is happening for Singapore is that the economy has started to open up after COVID. So at least the domestically focused sectors such as construction, travel, retail, and so on, they will do quite well. And I would say that the forecast of 3 to 5% is still achievable. But having said that, I mean, it's true that Singapore will face pressures from rising inflation, as well as the lockdowns in China, which are affecting supply chains, which will affect companies' abilities to expand their exports and so on. To what we should do, I think the first thing, of course, is to continue to keep inflation under control. It was 5.4% in March, which is a 10-year high, and I think the MAS will have to possibly continue tightening through this year, again in October, maybe even before that. Another thing the government can do is to continue to diversify imports, especially of food, so that we have lower food prices. To help the economy, what it there's limited scope, but what can happen is a ramp up in infrastructure spending, which is already happening, and companies probably should look closely at their supply chains and see if they can diversify and see if they can, replace suppliers who aren't able to deliver. So that's basically all we can do for now. But that said, I would say that 3 to 5% is achievable. But I suspect that if recessionary risks take hold, we will probably come in closer at the lower end of that range.
Vikram, thank you so much for your insights, Associate Editor Vikram Khanna.
Welcome. Thank you.
Thanks for watching. Be sure to subscribe to the channel and hit the bell icon to be notified of new videos.